In a world of digital dollars and abstract numbers on a screen, there is the house. Solid, real, something you can touch. Is this the safest and most powerful investment on earth? The answer might surprise you. For generations, there has been a universal dream. The dream of owning property. It feels different from the other investments we've discussed. A stock, as we learned in episode 10, is a piece of a business. A bond, as we explored in episode 11, is a loan. But they can both feel abstract. They are lines on a chart, numbers in an account. Real estate is different. It's tangible. It's bricks and mortar. You can stand in front of it. You can fix its leaky faucet. This feeling of realness makes it seem safer, simpler, and for many, the ultimate path to financial security. But is it really that simple? Consider the story of two siblings, Mark and Sarah. Both inherit a modest sum of money and decide to invest in real estate. Mark finds a charming single-family home in a quiet neighborhood. He does some quick math. The potential rent is much higher than the mortgage payment. It seems like a no-brainer. He buys the house, finds a tenant, and for a few months, feels like a genius. He's a property mogul in the making. Sarah is more cautious. She buys a small, less glamorous duplex in a different part of town. Before she buys, she spends weeks researching. She calculates not just the mortgage, but also property taxes, insurance, and sets aside money for future maintenance. The numbers are tight. After all expenses, she only makes about $100 in profit each month. Mark laughs at her tiny return. Then, Mark's water heater breaks. A $1,500 surprise bill. 2 months later, his tenant loses their job and stops paying rent. It takes him 3 months and legal fees to resolve the situation. In 1 year, his no-brainer investment has become a financial nightmare, draining his savings. Sarah, meanwhile, has a tenant move out, but she had planned for 1 month of vacancy per year. When a plumbing issue comes up, she uses the maintenance fund she built from day one. Her boring, barely profitable investment chugs along, a source of stability, not stress. Mark bought the bricks. Sarah understood the mortar. This is the crucial revelation of real estate investing. Success is not found in the physical building itself. It is found in the invisible structure that holds the investment together. The real secret to wealth in real estate is the mortar. This mortar is made of 4 key ingredients: leverage, cash flow, appreciation, and management. Understand these, and you can build an empire. Ignore them, and your dream house can become a house of cards. So let's break down this powerful concept. The first part of the mortar is leverage. This is the magic of real estate. When you buy a property, you typically don't pay for it all yourself. You get a mortgage. Maybe you put down 20%, and the bank puts up the other 80%. This is like having a business partner who funds most of the deal. If that $200,000 house goes up in value by 5% to $210,000, your $40,000 investment just made you $10,000. That's a 25% return on your cash. That is the incredible power of leverage. In a future episode, we will dive deep into mortgages, but for now, understand it's what makes real estate returns so explosive. The second ingredient is cash flow. This is the lifeblood of your investment. It's the money left over each month after you've paid all the bills. That means the mortgage, property taxes, insurance, and crucially, an allowance for repairs and vacancies. If your rent is $2,000, but your total expenses are $1,900, your cash flow is $100. That property is paying you to own it. If your expenses are $2,100, you have negative cash flow. You are paying to own that property. Mark ignored this. Sarah lived by it. The third ingredient is appreciation. This is the slow, patient growth in the property's value over time, driven by factors like inflation and local development. This is how real estate builds long-term wealth, letting the power of compounding we discussed in episode 1 work its quiet magic. And the fourth, and most overlooked ingredient, is management. A property won't manage itself. Someone has to find tenants, collect rent, and answer that late-night call about a broken toilet. You can do it yourself, or you can hire a property manager. but it is a real job that must be accounted for. Now, what if you want the benefits of real estate without being a landlord? What if you don't have a huge down payment? This is where the world of real estate opens up for everyone. The first way is through a real estate investment trust, or a REIT. Think of a REIT as the real estate version of the ETFs we fell in love with in episode 5. You can buy a share of a REIT on the stock market, and instantly own a tiny piece of hundreds of properties, office buildings, shopping malls, apartment complexes. The REIT handles all the management, and you get paid your share of the rental income in the form of dividends. It's diversification and professional management, all in one click. Another option is real estate crowdfunding. This is a newer model where you can go online and pool your money with other investors to fund a specific project, like a new apartment building or a commercial development. You can start with a much smaller amount of money and be a part of a larger deal. Real estate is not a get-rich-quick scheme. It is a business. Whether you own a duplex down the street or a share in a massive REIT, you are in the business of shelter. It's a powerful third pillar to add to a diversified portfolio of stocks and bonds. It can provide steady income, protection against inflation, and long-term growth. The key to unlocking that power is to look past the physical bricks and focus on the financial mortar that holds it all together. Whether it's a physical property or a digital share, the foundation of a great investment is always built with knowledge. That understanding is the most valuable asset we can own, and it grows strongest when we build it together. Our mission is to tackle the financial questions you're actually asking. Let us know in the comments what practical challenges you're facing, and your idea could shape a future episode. Subscribe and join the conversation.